Hi, I'm Jose Armenta, and this is your Federal Employee Benefits, where we cover topics aimed at helping first federal employees like you make smart financial decisions. Today, we're going to discuss tax diversification. What is it and how it can help you lower your tax bill in retirement. Now, if you're new here, hit that subscribe button so you don't miss any future videos. Now, let's dive in. Now, most federal employees that come to me for help have most of their funds in the traditional TSP. And while saving in your TSP over your career is a great thing, having all of your money in one account type, so the traditional TSP, a tax-deferred account, one tax account type, limits your flexibility in retirement. Just like you want to have diversification in your investments to have your risk spread out through the different TSP core funds, it's a good idea to have tax diversification to help give you some flexibility when withdrawing your funds in retirement. Now, when I say tax diversification, what I'm talking about are the three tax buckets. You have tax deferred accounts like your traditional TSP, your traditional IRA, where you put pre-tax money that has not been taxed in, and then when you pull the money out, the funds are taxed. The next bucket is tax exempt, or the Roth accounts, where you put money in that has already been taxed, and then once you pull it out in retirement, it is tax-free. And then the last bucket, the third bucket, are your taxable accounts, okay? Your non-retirement investment accounts, your non-retirement brokerage account. Now we're gonna discuss how utilizing all three of these can help you lower your tax bill in retirement. Okay, so let's do a quick review of each bucket and the pros and cons of using each one. So the first bucket, again, is the tax deferred account, your traditional TSP, your traditional IRA. Now the benefit of using this account is you get a tax reduction up front. The monies that you put into these accounts are reduce your taxable income in the year that you fund the account. So if you put $10,000 into your TSP for that tax year, you're reducing the income that you're going to pay taxes on by that amount, $10,000. So it's a really useful account type for individuals who are higher earning, right? If you're in your higher earning years later in your career, then this is an account type that you may want to use because you're probably at the highest tax bracket. You're paying taxes at the highest rate that you're going to pay them at. And so getting a tax rate at that moment, right, in those years where you're paying at the highest rate is going to be helpful. However, only utilizing this account limits the strategy that you can have when you're taking money out. Because remember, all of the money you put into these tax deferred accounts, your traditional TSP, your traditional IRA, none of this money has been taxed yet. And so every penny that you pull out in retirement will be taxable income. So that can impact how much of your Social Security is taxed in retirement, how much you pay for Medicare in retirement, because these benefits, these income streams are based off of the way they're taxed is based off of your taxable income. So being able to lower your taxable income in retirement can impact different elements of your financial profile. So that's what's positive and potentially negative about using the traditional account, your tax deferred accounts. Now, the next account type, again, is your Roth accounts, right? Your Roth TSP, your Roth IRAs. Now, these account types, the good thing about these account types is that the income you pull out in retirement is tax-free because you pay the taxes before you put the money in. And so you pay taxes up front, you put the money in the account, it grows tax-free, and when you withdraw in retirement, the funds are tax-free. Now, that's what's good about the account. The negative about this account is that you have to pay the tax bill up front. Okay, there is no deferring the tax bill until later. So if you're in your higher earning years, if you're later in your career and you're paying taxes at the highest rate that you're likely going to pay them, using this account where you're paying taxes at that moment, in that year, may not be the best strategy for you. But having some tax-free money in retirement can be very useful. So again, there's a positive and there's a negative to using this account type as well. Now, the last bucket, again, is the taxable account type. It's the non-retirement account type, your regular brokerage account. And the positive about using this account is that you can get preferential tax treatment. So whereas the money you pull out from your traditional IRA, it's going to be taxed. It's what's called your ordinary tax rate, the tax rate that you pay on your salary. With a non-retirement account, the brokerage account, if you hold your investments for longer than a year, you can pay preferential treatment. So if you sell, let's say you sold a stock after holding for a year, you would pay taxes at the preferential long-term capital gains rate, which is lower most of the time than what your ordinary rate will be. Also, if you have any qualified dividend on your investments, that will also be paid at the preferential rate, which often is lower than your ordinary tax rate. So that's what's good about having funds in the non-retirement account, your regular brokerage account, also known as your taxable account. Now, what's negative about this account is that there is no tax deferral. So any investment sales that you have, any qualified dividends that you have, any interest income that you have is taxable in the year that you receive that income. There is no postponing paying your tax bill until later, like with the retirement accounts. And so that's the negative about this account. So there's pros and there's cons to using each account type. While there are pros and cons to using each account type, when you combine all three accounts, when you have funds in all three accounts, you have a lot more flexibility in retirement. Because keep in mind that we have a progressive tax system. So the more you make, the more income you have each year, the higher the tax rate you'll pay. So in retirement, if you can combine your taxable income from the tax-deferred accounts with some tax-free income from the Roth accounts, and then the preferential tax treatment from your taxable account, your non-retirement accounts, you can be strategic and the amount that you will draw from each account type to lower the tax rate that you're going to pay. Now, I'm not going to go into the details of how you can do this. That'll be the second part of this two-part series. So keep an eye out for that in the next few weeks, where I'll go into more detail on exactly how you can withdraw from each bucket in retirement once you have built that tax diversification. But that is the end goal. Build up these three buckets so that you have more flexibility in retirement. Now, while using all three account types can mean that you're going to pay more taxes up front because you're not putting all of your money in the tax deferred account and getting a tax break up front. The goal is to lower your overall tax bill over your lifetime. So being strategic, funding some tax deferred, some Roth, some taxable, systematically throughout your career, and then being able to have more flexibility in retirement to lower the taxes you pay in retirement. Doing that strategically can lower your lifetime tax bill, which is the goal. Pay the least amount of taxes over your lifetime. I hope you enjoyed the video. If you did, please hit that like and subscribe button. That's the best way to support this channel. And if you're interested in learning more about how my financial planning firm can help you with your financial planning and retirement needs, go ahead and use the link below to schedule a free consultation today.